You check your balance before you swipe. Not because you're panicking, just to confirm. It's a habit, a small private ritual you developed without naming it. The quick tap, the number, the exhale. It's $12. The coffee is $4. You swipe. The transaction clears. 8 hours later, the notification arrives. Your account is overdrawn. You did the math. You know you did the math. But the bank system processed your larger transactions first. Your phone bill, your subscription, the charge you forgot about from 3 days ago, before it processed the coffee. That sequencing wasn't random. It was a setting. A decision made somewhere in an operations meeting you were never invited to, baked into a terms of service document you agreed to without reading, designed, and this is the part that matters, to maximize the number of individual transactions that cross zero. The coffee cost $4. The fee for the coffee cost $35. You didn't go $100 negative, you went $3 negative, maybe $4, and the bank charged you $35 for the privilege of covering that $3, which is called overdraft protection, a name that tells you everything about how it was marketed and nothing about how it works. We're talking about the major retail banks, the ones with the marble lobbies and the flags outside, and the taglines about being there for you. The ones most people in this country use by default because they're everywhere, because they were there first, because switching feels like more trouble than it's worth. You are not bad with money. You lost a game whose rules were never posted anywhere you could see them.
Here's what the bank saw when you swiped that card. Not a person who made a mistake, not a loyal customer of 6 years, not someone who deposits every paycheck within 48 hours and has never intentionally gone negative in their life. The bank's system saw an account with insufficient funds. It ran a process. The process produced a fee. The fee was $35. That's it. No judgment, no context, no consideration of who you are, what you intended, or what the $35 will mean to you this week. Just a number, a threshold, and a fee on the other side of it. In the time it takes you to read this sentence, somewhere in America, that same process is running on roughly 50,000 other accounts. Not because 50,000 people are irresponsible, because 50,000 people crossed zero in a system calibrated to notice exactly that. U.S. banks collected over $7 billion in overdraft fees last year. The customers who paid the most of it weren't people who went hundreds of dollars negative and couldn't recover. They were people who went slightly negative, got charged, recovered, went slightly negative again, a cycle so reliably repeatable that the industry has a term for it. Repeat overdrafters, not a warning sign, a revenue segment. You were not a customer in distress. You were a product performing as designed. And the bank, the institution you trusted with your money,
Quick, if you
the one
have
with
been
the
enjoying
marble
the video so
floors and
far,
the flag
make
outside,
sure to turn on the
and the
notification
tagline
bell
about
so you
being
won't miss
there for
any
you,
future
knew
videos.
that. It just didn't tell you.
So you do what anyone does. You call the number on the back of the card, you wait 11 minutes, you explain, carefully, that you've been a customer for 6 years, that this has never happened before, that $35 for a $3 overage feels, and you choose the word carefully, unreasonable. The representative is polite. She looks at your account, she waives the fee. This time, you hang up feeling like you won something. You didn't. You received a discretionary gesture from a customer service rep whose system flagged first-time waiver requests as low-risk retention tools. The waiver cost the bank nothing. The goodwill it generated cost you 11 minutes and the mild humiliation of having to ask. You'll think twice before calling again. That's the point. The trap isn't the $35. The trap is the cycle the $35 creates. Here's how it runs. You go slightly negative, you get charged $35, your next deposit now has to cover both your actual expenses and the fee. That makes the next shortfall more likely, not less. The fee doesn't punish the overdraft, it deepens it. 9% of account holders pay 80% of all overdraft fees. That 9% is not the group that went hundreds of dollars negative once. It's the group that goes slightly negative repeatedly. This is not an accident. It is not a design flaw that survived because no one noticed. It is a product.
There's a small banner in your online banking portal, a green check mark next to the words, "Stay protected. Enable overdraft coverage," and something about peace of mind, about never having a transaction declined at an awkward moment. And because it's framed as protection, because declining feels like inviting embarrassment, most people choose it without reading what they're choosing. The alternative, which the bank does not emphasize, is that without overdraft protection, a declined transaction costs you nothing. The card simply doesn't work. The coffee doesn't go through. You are mildly inconvenienced. You are not charged $35. The protection protects the bank's fee revenue. You paid to make that possible. But eventually, something shifts. Not because the bank changes, because the number does. You get a raise, you pick up a contract, you move somewhere cheaper, some combination of income and discipline and luck and time pushes your average balance above zero and keeps it there. The cycle breaks, not dramatically, quietly. The notifications stop. The mental overhead of the pre-swipe check fades. The $35 fees disappear from your statement. You have, at some point in this process, crossed $2,000. And you exhale.
Here's what you don't notice, because why would you? The bank has not changed how it sees you. You've crossed out of the penalty tier. The system no longer flags you as a fee generation opportunity because you no longer have the balance pattern that triggers those flags. But you haven't crossed into anything new. You are, in the bank's internal language, a standard retail customer. Your account costs roughly $250 a year to service. You generate, in fees and float, slightly more than that. You are marginally profitable. You are not interesting. There is a phone number at this bank, a direct line to someone whose job title includes the word advisor. You have never been given this number. You don't know it exists. It exists. There are rate structures available at this institution that are not published on the website. Certificates of deposit with yields above the advertised rate. Savings accounts with fee waivers not available to the general customer base. Mortgage products with pricing that doesn't appear on any rate sheet. You qualify for none of them. Not because you're not creditworthy, not because you haven't been a loyal customer, not because there's something about your financial behavior that disqualifies you, because your balance is $2,200. The bank knows what it has in you. It has a customer who costs less than average to retain, generates a modest but predictable return, and poses minimal churn risk because switching banks is annoying and you haven't thought about it. That's sufficient. That's all you are at this level. Sufficient. The bank is not going to reach out. It is not going to explain what's available above your current tier. It is going to send you the same automated emails it sends everyone, process your direct deposits within the standard window, and wait. It is waiting for your number to change, because when your number changes, so does everything else. The email arrives on a Tuesday. Subject line, an exclusive offer for valued customers. You've seen this before. The bank sends promotions, credit card offers, referral bonuses. You've learned to ignore them the way you ignore everything that arrives with the word exclusive in the subject line, because exclusive, in your experience, has always meant mass-produced. You almost delete it. You don't. Inside is an offer for a money market account. The rate is higher than your checking account. Not dramatically, but noticeably. There's a minimum balance requirement to open it. The minimum is $10,000. You have $10,400. You sit with that for a second. Here's what actually happened. Somewhere in the bank system, your account crossed a threshold. Not $10,000 exactly. The specific number varies by institution, but the logic is universal. At a certain deposit level, your account gets reclassified, not in a way you're informed of, not in a way that generates a letter or a call or any human acknowledgement whatsoever. An algorithm reclassified you automatically into a segment the bank calls emerging affluent or mass affluent prospect. That segment receives different marketing. That's what the email was. Marketing targeted at a segment you just entered without knowing segments existed. But here's the thing about that email, and this is the part that should stop you. The money market account it's offering has always existed. It was available last year when you had $6,000. It was available the year before that. The rate it's offering didn't appear this week. The product didn't launch this week. Nothing new was created for you. It was simply not shown to you until the number changed. The bank has always had products designed for people with more money. It just doesn't advertise them to people with less. Not because it's hiding them exactly. They're on the website if you know to look. But the bank's marketing system, its outreach logic, its exclusive offer email cadence, all of it is calibrated to show you what your balance says you're ready for. You are not being rewarded for reaching $10,000. You are being shown something that was always there. Now that the bank has decided you can see it, the number changed. That's it. That's the whole story.
Real quick, if you have been enjoying the video so far, make sure to turn on the notification bell so you won't miss any future videos.
You open the money market account. The balance grows. Not quickly, not linearly, but steadily. At some point, the number crosses $100,000. You know the day it happens because you check. You've started checking differently now, not with the pre-swipe anxiety of the overdraft years, but with the specific attention of someone who understands that the number matters in ways they're still learning. 3 weeks later, your phone rings. Not a 1-800 number, a direct line with a local area code. You answer. Her name is... It doesn't matter. What matters is that she uses your first name within the first 15 seconds of the call, that she already knows you've been a customer for 9 years, that she mentions, without being asked, that she noticed your account balance has grown significantly over the past 18 months, and she wanted to personally reach out. She is a personal banker, not the person at the branch who processes deposits, a different role entirely at a different level of the institution, whose specific function is to manage relationships with customers whose balances have crossed a threshold. She has a direct number. She gives it to you. She mentions that given your current balance, you may be eligible for rate structures that aren't available through the standard account offerings. She mentions this casually, as though it's a minor administrative note. It is not a minor administrative note. It is the bank acknowledging for the first time and in a live human voice that there are 2 different versions of this institution and that you have just crossed the line between them. She asks if you've thought about a CD. She has a rate in mind. It's 0.4% above the published rate. On $100,000, that's $400 a year. The bank has the margin to offer you this. It has always had the margin to offer you this. It simply didn't until the number made it worth their while to try to keep you. You get off the phone and sit with it. Something feels different. Not wrong, different. The bank has been in your life for nearly a decade. You have cleaned up after its fee cycles. You have navigated its automated systems. You have waited on hold. You have been, for the most part of that time, a customer in the most anonymous possible sense of the word. A deposit account, a routing number, a line in a segment report nobody with decision-making authority has ever read. And now someone called you. Not because you called first, not because you complained, not because you filled out a form or applied for a new product or did anything at all except allow a number to grow. The bank's behavior towards you changed. You did not change. Your financial habits didn't change. Your creditworthiness, your loyalty, your tenure as a customer, none of it changed. None of it was even mentioned on the call. The number changed, and the institution that processed your overdraft fee at 2 a.m. with an automated notification, the same institution, the same legal entity, the same building, sent a human being to call you personally and offer you a rate that doesn't exist on any published schedule.
This is when the shape of the thing becomes clear. It was never about you. It was never about your habits, your discipline, your character, your choices. The penalty fees at level 1 were not a verdict on who you were. The invisibility at level 3 was not a reflection of your worth. The call you just received is not a recognition of your growth as a person. It is a recognition of a number. And if the bank's behavior can shift this completely, this specifically, this personally at $100,000, the question that now sits in the room with you is unavoidable. What happens at $1 million? You walk into the same branch you've used for 9 years. Same building, same address, same logo above the door, but this time, when you approach the front desk, something is different. You're not handed a ticket. You are not directed to the teller line. The person at the desk looks at you in a way that is specific, prepared, expected, and says, they're ready for you in the back. The back. You have walked past this part of the branch for 9 years without knowing what it was. A glass-walled office, visible from the lobby but separated from it. Quieter, different furniture, a door that closes. You assumed it was for complaints, for mortgage applications, for something administrative and slightly unpleasant. It is not. It is where the bank conducts relationships. Inside, there is a person whose title is not personal banker. The title is relationship manager. The distinction is not semantic. A personal banker manages accounts. A relationship manager manages you, your full financial picture, your accountant, your estate plan, your business structure, your liquidity needs, your intentions. She has reviewed your accounts before this meeting. She has a document. It is printed, bound at the corner, and it has your name on it. She offers coffee. She uses your name without looking at a screen. This is private banking, not a separate institution. The same bank, the same deposits, the same legal entity that charged you $35 for a $4 coffee, but a different floor of it, reserved for clients whose assets have crossed a threshold that qualifies them for a category of attention that is never advertised, never explained, and never offered, only unlocked silently when the number warrants it. At this level, fees are not waived by policy. They are waived by judgment, her judgment. If you mention a wire transfer fee seems unnecessary, it disappears. Not because the bank changed its policy, because she decided. That discretion, the ability of a human being to override the system on your behalf, is what you are actually receiving at $1 million. Not better products, better staffing. The rules haven't changed. You now have someone whose job is to make them work for you. But there is a level above this. There is always a level above this. You don't call your bank anymore. Your bank calls your office, not a relationship manager, someone whose title includes the word director. She is flying in from the regional headquarters. Her assistant emailed your assistant to schedule. She has prepared a proposal, a custom fixed income structure built specifically for your liquidity profile that does not exist in any product catalog because it was constructed for you specifically this week by a team whose job is to build things for clients at your tier. This is not a hypothetical. This is standard practice at every major private wealth division in the country. She is not servicing you. She is pitching to you. The bank needs your deposits, not in the vague general sense that banks need deposits, in the specific, regulatory, balance sheet sense that your $10 million of deposits help satisfy reserve requirements, supports the bank's lending capacity, and signals stability to the rating agencies that determine the institution's borrowing costs. You are not a customer anymore. You are infrastructure. And the bank, which cannot afford to lose you to a competitor, which has calculated the cost of replacing your deposits against the cost of a plane ticket and decided the plane ticket is cheaper, is performing for you now. Every interaction is prepared. Every rate is negotiated. Every fee is invisible. The 800 number you used to call and wait on hold for 11 minutes, the automated system you navigated with mounting frustration, the representative who offered you a one-time waiver as a retention gesture, none of that exists for you anymore. It exists somewhere in the same institution. Right now, someone is waiting 11 minutes. You just don't have that number anymore. You have a mobile, one name on it, no hold music.
Here is the complete picture. The same institution, the same charter, the same marble lobby, the same flag outside, the same tagline on the website about being here for you. At $0, it charges you $35 for going -3 and calls it a service. At $2,000, it acknowledges your existence and nothing more. At $10,000, its algorithm notices you and sends a targeted email. At $100,000, a human being calls you with a rate that doesn't appear on any published schedule. At $1 million, a professional is assigned to make the rules work in your direction. At $10 million, the bank sends a director on a plane to keep you. The rules didn't change at any of these levels. The number did. That $35 fee was not a verdict on your character.
The invisibility of the 2K years was not a reflection of your worth. The call you received at 100K was not a recognition of who you became. All of it, the penalties, the silence, the warmth, the plane ticket, was the bank responding to a number, a single variable, a figure in a system that has no mechanism for seeing anything else. You were never the problem. You were never the point. You were a number that hadn't reached the threshold that made you worth pursuing. Now you know where those thresholds are. Now you know what they unlock. Now you know that the institution on the other side of every one of them is the same institution that charged you $35 at 2 a.m. and called it protection. The game didn't change. You just finally got to see the board.